Hello and welcome to the December Fund update for the Pure Income and Growth Fund and the Pure Resources Fund. I'm Nick Berry, Portfolio Manager and co-founder of the fund. After rallying in November, the market declined in December, with the S&P ASX Small Industrials falling 3.5%. In the context of this, the fund experienced modest growth of 0.2% for the month. Similarly, the Small Resources Index declined 3.1% in December, with the Pure Resources Fund outperforming, albeit at a smaller decline of 1.2%. Turning to the outlook for 2025, we believe there is room for optimism on small company performance, particularly and finally microcaps in the year ahead. Forecast interest rate cuts, continuing M&A activity, and improving access to capital all bode well for the coming 12 months. We spent much of 2024 highlighting our belief that smaller companies were primed to start outperforming larger companies again, after the longest winter of underperformance we have seen in our careers and beyond. And looking back over the last 12 months, the MSCI Microcap Index did actually outperform the ASX 100. This is an encouraging start, but the index is still down 19% over the last 3 years, compared to 12% growth in the large cap index. Interestingly, contrasting this with the US where rate cuts have already occurred, Aussie markets lagged the US's performance. However, excluding the Magnificent Seven, the US S&P 500 only rose 6% in 2024, underperforming the small cap index as in Australia. Comparatively, Australia has been behind the curve in curbing inflation after, in our view, a handful of disastrous Labor government policies surrounding energy, the quantum of immigration, and questionable growth in government employment. These fiscal issues have forced the RBA's hand with respect to not cutting rates sooner. However, the two-speed economy that we've seen emerge over the last 12 months, the haves and have-nots if you will, has finally seen inflation trend to within hitting distance of the RBA's target inflation range. And this is the key point. On balance, economists are now forecasting interest rate cuts in Australia of 75 to 100 basis points in 2025, and rate cutting cycles have historically proven fertile ground for smaller company performance. Consider this chart showing the last 5 rate cut cycles. In the 24 months following the first rate cut, the ASX Small Industrials has increased, on average, by 11%. When there is the potential for a series of interest rate cuts, the outlook is even more encouraging, with the average performance of the ASX Small Industrials reaching 29% over 24 months. Macquarie Research expects Australian small caps to have higher earnings growth than large caps in 2025, and while there is still room for improvement on access to capital, excluding the rescue equity raises of 2020 and 2021, the amount of capital that listed market participants were able to access in 2024 was at its highest level since 2019. Turning briefly now to company updates, we expect capital growth to be the predominant driver of value for both funds in 2025. For the Income and Growth Fund, we believe key portfolio holding DXN is primed for a significant re-rating. FY25 revenue is guided by the company to grow 50% year on year, in the broader context of a modular data centre market forecast to more than double over the next 5 years. Not only is DXN in the slipstream of a rapidly growing industry, it's also taking strong market share. On the subject of market share growth, key portfolio holding Better Beer enjoyed its highest volume and sales month ever in December, with the number of outlets stocking Better Beer now over 6,000 compared to 2,200 last year. With Better Beer now approaching the same size as Stone & Wood was when Lion Nathan acquired it for $500 million, we are optimistic about the value creation this position can generate for the fund this half. Turning to resources, we remain positive on the outlook for gold. Our exposure here is via Kingston Resources, who is scaling up gold production at their mine in central New South Wales, where processing commenced in August last year. Through the inevitable early stage teething that comes with ramp up, we expect mining and processing rates to be on the improve in early 2025 and for the company to continue to generate positive free cash flow. One to keep an eye on as they also dispose of a non-core asset which could yield a handsome sum given the current gold price. Elsewhere, we're not sure how many times we can say this or if politicians just don't care anymore, but we are running out of gas on the east coast of Australia. Our exposure to this sector comes via Comet Ridge, which has been a great position for us over the past 3 years. Looking to the coming 6 months, we see a number of key catalysts to drive further value here. And with a recent capital raise completed, the $22 million of cash that they have will now see them through to first gas hopefully later this year. And when I say hopefully, this project is of such strategic importance. It's the difference between having your air conditioning running in Sydney next summer or keeping the heat on in Melbourne over winter. Might be time for the politicians to start listening. Thanks for watching, and we'll see you again next month.